Hey everyone, I'm Sean with Modest Wallet, and today we're talking about investing for beginners. Investing is one of our absolute favorite subjects when it comes to personal finance.
Thrilling subject.
And I get it, if you're new to it, it can be quite challenging. In this video, I want to hopefully break down what investing is, why it's important, as well as when you might want to start. Finally, I'll share 5 steps on how a beginner can start their investing journey. If you're new to the Modest Wallet YouTube channel, I'm glad you're here.
I'm glad you're here.
Don't forget to subscribe, click that little bell so you get notifications every time we release a new video. And as always, I appreciate all the loyal subscribers out there. Please share our channel with others as we continue to grow and hopefully bring value to you and others with our Money Made Simple videos. Enough of that, let's talk about investing for beginners.
Says it's for beginners.
Before we can just jump in and talk about how to invest, we need to answer a few basic questions. The first basic question is, what is investing? Investing is defined as the act of committing capital or money to an endeavor with the intention to make more money. In most cases, the amount of money you can make in an investment is directly correlated to the amount of risk being undertaken. More simple layman's terms, investing is putting your money to work so it can make more money.
I'm considering investing.
That leads us to our second question, which is, why is investing important? Investing has never been so important until you consider the rate of interest being paid by traditional banks. The average annual interest rate is still below 0.1%. In comparison, the wider stock markets have historically grown at a much faster rate. Even more importantly, if you don't start investing your money, it will lose its purchasing power.
Adjusting for inflation.
This is because of inflation. Put simply, if inflation stands at 2% for the year and you earn just 0.1% in your bank account interest, your money is essentially worth 1.9% less. Investing ensures present and future financial security. When you invest your money, your dollars are put to work to make even more money. Then those dollars get reinvested to generate even more dollars. The money generated through your investments and reinvestments allows your dollars to grow over time, and this is known as compound growth. The idea is for your money to grow faster than the rate of inflation in order for you to build wealth over time. Now let's talk about a third question, which is, when should I begin investing? The short, super to the point answer is now. I do say that with a little hesitancy because building up an emergency fund, which is money set aside for life's emergencies, usually 3 to 6 months worth of expenses, is really important, as well as eliminating debt, especially that high interest debt, which might be your first steps before you start investing. Besides that, I get it, you might be tempted to try and time your entrance into the financial markets. However, there is no time like the present, especially if you are looking to invest in the long term through the dollar cost averaging strategy. Dollar cost averaging refers to the practice of systematically investing equal amounts spaced out over regular intervals regardless of price. Anyway, the younger you start investing, the more time you will have to build wealth and take advantage of the power of compound interest. Let's look at this example where we start with $1,000 and invest $1,000 annually. Instead of just being worth $10,000 over 10 years, you can see it would actually be worth $20,124.91 over those 10 years at a 10% annual interest rate. Compound interest is so powerful.
Strangely powerful.
Now that we talked about what investing is, why it's important, and when you should start, let's look at a 5-step process for how a beginning investor should start. Step 1, you first need to decide on an investing approach. And that really comes down to 2 types of investing, active and passive. As the name suggests, if you are an active investor, you will actively look to research the markets and ultimately choose which assets to buy and sell. You will also be responsible for timing the market.
Great timing.
For example, you might decide to buy Apple stocks and hold them for maybe a month, 2, maybe several months. As an active investor, not only do you decide which asset to buy, but also when to enter and exit the market. On the other hand, passive investing is the polar opposite of its active counterpart. This is because you will take a hands-off approach to investing. You can achieve this by investing in a fund. This might be an index fund that tracks the Dow Jones, S&P 500, or maybe even an ETF that tracks a portfolio of dividend stocks. Mutual funds and robo-advisors are examples of passive investment vehicles. The key thing here is that once you have passively invested, there is really little for you to do. Your chosen fund will determine when to buy and sell, and really even when to do that. Ultimately, although the thrill of picking and choosing your investments can be exciting, if you're an inexperienced and/or time-strapped investor, you might want to opt out for the passive strategy. Once you've determined your investing strategy, the second step for investors is to decide on an asset class.
Asset. An expendable asset.
Each asset class will come with its potential risks and rewards, so this part of the investment decision-making process is incredibly important. Let's discuss some of the main assets you might consider adding to your portfolio. Perhaps the most popular asset class for investors, both newbies and seasoned traders, are traditional stocks. Most investors in the US will focus on the two primary domestic exchanges, the New York Stock Exchange and the NASDAQ. With that said, many online brokerages will give you access to the international markets. Additionally, you need to consider the type of stock you're interested in. For example, blue chip stocks are typically companies that have a long-standing reputation in their respective sectors and ultimately carry less risk. Growth stocks, dividend stocks, and cyclical stocks are just to name a few. As you can imagine, knowing which stocks to add to your investment portfolio can be quite a daunting task.
It is daunting.
This is again one of those reasons why you might be better off sticking with a passive form of investing with things like index funds or ETFs. Index funds and ETFs allow you to invest in large groups of stocks that track an index of a large group of stocks. This really gives diversity to your portfolio and goes up or down depending on the index that it is tracking or following. You also have lower fees than if you have a more managed fund like a mutual fund. In a mutual fund, a manager buys and sells groups of stocks in hopes of beating the index or the market. Lastly, when it comes to stocks, ETFs, index funds, or mutual funds, you can make money from those stock investments in two ways. Put simply, if you sell your stocks for a higher price than you were originally paid, the proceeds are known as capital gains. For example, if you bought a stock at $100 per share and sold it at $150 per share, your capital gains would be $50 per share. Then there are dividends. Many US companies pay dividends. This means that the company distributes some of its income to stockholders. Dividends are usually paid every 3 months and will typically offer a yield in the 2 to 5% range. I'll make the rest of these asset classes a little shorter to discuss.
Thank you very much.
The next asset class are bonds. A bond is a loan to a company or government that pays investors a fixed rate of return over a specific time frame. Unlike stocks, your returns on bonds are predictable. This is because bonds come with a fixed rate of interest, so you always know how much money you will make. Next, we have cash and cash equivalents. This ensures that there are funds available to cover short-term debt obligations or to enter into new investment opportunities. With that said, it is also possible to earn interest by putting your cash into an interest-bearing account. The interest you can make by holding cash will be tiny in comparison to the opportunities available in the wider investment scene. Another asset class we have are futures or derivatives. If you're new to the world of investing, then financial derivatives like futures and options will not be for you. Futures and options are also short-term products, so you'll need to be actively entering and exiting positions. That's to ensure you're trading in a risk-averse manner. Moving on, well-diversified portfolios will often allocate funds to commodities and precious metals like gold and silver. This really ensures that you are not overexposed to the wider stock markets. During times of economic uncertainty, precious metals like gold will often thrive. This is because gold is often viewed as a safe haven and subsequently a hedge against a falling stock market. You don't just need the physical metal, you can invest in ETFs as well. This allows you to get direct exposure to the value of the asset without worrying about storage or really logistics. We're getting close to the end of these asset classes, and real estate is next. Real estate is a strong and solid investment sector, especially in the US. The key problem with this is that this industry is typically reserved for those with the capital to purchase a property outright or through a long-term mortgage. The good news is you don't have to purchase a property to gain exposure to the real estate scene. There are hundreds of publicly listed REITs, real estate investment trusts, that are active in the market. REITs are similar to mutual funds insofar as the provider will purchase assets on behalf of its investors. That might include commercial properties, residential units, healthcare facilities, or even shopping malls. Finally, many investors will also allocate funds to alternative asset classes. This typically refers to an asset that sits outside of stocks and bonds. Examples include cryptocurrencies like Bitcoin, fine art, rare whiskey, NFTs, and peer-to-peer lending. The alternative investing space does come with its benefits and drawbacks. In terms of the positives, you stand a chance to earn a much higher rate of return. As a prime example, Bitcoin increased by over 1,000% in 12 months preceding April 2020. However, what comes with higher than average returns is enhanced risk. This is to say that alternative investments are a lot more speculative and volatile than traditional assets. Now that we defined the many asset classes, let's look at step 3, which is to define your goals and time horizon. This involves the short-term and long-term and your risk-reward profile. The broad definition of short-term investing is an investment that you hold for less than 12 months. With that said, short-term investing can refer to active trading strategies such as day trading or swing trading. This means that you might keep hold of an investment for a few weeks, days, or even hours. This type of investing is best reserved for those that have the time and resources to actively monitor and research the wider financial markets. Not only do you need to choose the right investment, but you'll need to enter and exit the market at the right time. Unless you have experience in the investment arena, this is a difficult feat to achieve. Naturally, long-term investing refers to investing that is held for at least 1 year. However, this type of investing will see someone hold something for much longer than a year, maybe even decades. For a newbie investor who doesn't really have the time to actively master the art of trading, long-term investing is ideal. This is because you don't need to concern yourself with short-term volatility. Instead, you will look to ride the ups and downs of the financial markets. Long-term investing is typically suited for those who are working towards a retirement nest egg. Step 4 is to open up a brokerage account. Let's be honest, you could probably read a ton of blog articles or even watch reviews on YouTube, hopefully from the Modest Wallet. That would probably be why one brokerage is better than another. At the Modest Wallet, we try to explore the best options for you, and that's based on your investing needs and goals. I'll leave several links in the description so that you can make your choice. Ultimately, choosing and opening a brokerage account to invest in should be about how to keep your fees low and not cut into your returns. Account maintenance fees, commissions, mutual fund loads, and management or advisor fees can pay a major toll in your investment. The competition in this space is heating up, which means many of these brokerages are slashing their fees to zero. And that's amazing news to beginner investors. The other area you want to consider when choosing a brokerage to invest your money with are the types of accounts that are offered. For example, I may not be interested in investing with Robinhood if I want to open up a Roth or traditional IRA because they really do not offer that. If I want a hands-off approach and just have to deposit money and let the robo-advisor do the work for me, a firm like Wealthfront might be for me. You might be someone who wants a physical advisor in your corner, and that's okay, so you might need to shop around to find the best one that really meets your needs. Lastly, step 5 for investing for beginners is monitoring your investments. Perhaps the most important tip to consider is making sure your investments are diversified. This means that you spread your investment capital into different assets, markets, and economies. The overarching benefit of diversifying is that you are covering several potential outcomes. For example, if the stock markets are down, then it is hoped that your investment into gold and bonds would help counter some of those losses. Additionally, rebalancing your portfolio is important. This means reassessing your chosen investments and evaluating whether they still align with your long-term financial goals. If they don't, you might decide to add, remove, or replace some of your assets in your portfolio. Ultimately, you don't want to put all your eggs into one basket. That was a ton of information as you start your investing journey. Investing is fun, or at least it should be. You can do it whether you learn a lot and know exactly what you're doing, or you just know it's important and are willing to sacrifice your hard-earned money with a brokerage that does the work for you. As I mentioned early in the video, I will leave some valuable resources in the description below. Don't forget to leave us a comment in the area below about your financial journey, and if you found value in this video, don't forget to hit that like button. That is one way you can really help support the channel. Thanks for watching, and I'll see you over at themodestwallet.com blog.